When investors think about wealth, they often focus on gross returns, opportunities. They talk about what's the ROI that I'm going to be getting. But one of the most important factors around investing is liquidity. Now, it's far less exciting, but it is the hidden force behind every market. And that's what we're going to delve into today. So, welcome. My name's Karen Newton. I'm a business and wealth strategist. And to all my international followers out there, I'd like to say welcome, bonjour, hola, and ni hao. So when we talk about liquidity, what is it? And liquidity is simply when you have an asset, how quickly can you convert it to cash? So let's take shares. If you own a share portfolio, you can sell shares now. And with a lot of platforms, you could access the money by the end of the day, maybe tomorrow. Right? That gives you liquidity very quickly. But if you take a property, before you can get the financial return from a property, you have to put it up for sale. You have to have a buyer. You have to have contracts, go through the whole process. So property, although it's a good investment, it does not have good liquidity. And liquidity is one of the most important things that every investor needs. And I'm going to talk about some examples of what I've come across recently. Now, as I go into these stories, they might not sound like they are liquidity, but they're all connected. They're all different stories. They're all connected because the people concerned or the countries concerned are worried about liquidity. So the first thing I want to talk about is Morgan Stanley's North Haven Fund. Now, this is a big fund. There's a lot of investors in it. And they have suddenly had a lot of withdrawals. Now, the governance of the fund states that 5% of assets can be withdrawn every quarter. Except in the last quarter, it was 11.9% return. Sorry, 11.9% that was drawn down. And in this last quarter, it was 11.6 that was drawn down. Just verify my numbers there. 10.6 in the first quarter, 11.6 in the second quarter. Now, that's not North Haven Fund's issue. Okay. It's all the people who are invested in that fund have a reason for drawing their money down. And based on what's happening around global economies at the moment, it's easy to say it is liquidity is behind the reason to draw that money down. So like I said, it's not a North Haven Fund issue because Morgan Stanley's a pretty solid bank. It's the people who are invested in there who suddenly find themselves needing the money for one reason or another. And that is liquidity on the part of the investors. Now, a second story that caught my eye last week was China, because China has a pretty high leverage trading around gold and silver. And it made the decision that retail investors were not going to be able to access leverage trading as of the 1st of July. And anyone that has accounts already has to sell up by the 24th of July. And that is leverage trading around gold and silver being removed from retail investors. The reason for this? Gold is pretty volatile at the moment. All markets are pretty volatile. And so China has identified that its investors, the people who are using leverage trading, are at a very high risk of finding themselves short of money and having to pay back a lot more than what they've invested. It doesn't mean China's banned gold. I've seen headlines around the place that said China's banned gold. Load of rubbish. China is investing in gold. The central bank has invested for 19 consecutive months into building gold and silver reserves. So China is not anti-gold or silver at all. What it is doing is looking at what's leveraged and what liquidity the leveraged investors have to meet any shortfalls that come up quickly. Now, in crypto, we have seen a similar situation, again around liquidity, and that is Michael Saylor's strategy. Now, I saw a headline the other day that Saylor had sold Bitcoin, the market reacted, the prices went down. Yet in the holdings that he's got, it was a very small proportion of coins that he sold. At the time when I was reading the data, Strategy had something like 845,000 Bitcoin, and it was selling about 300, like a very small amount in the scheme of what they hold. But that was how Strategy was finding the liquidity to pay preference shareholders. Preference shareholders have been investing in Strategy. They have been helping Strategy to buy more crypto, but the dividends that they are due on those, Strategy needed to just offsell a little bit of Bitcoin. However, a few days later, they turned around, they bought another 1,500 Bitcoin. So they're up higher now than they were when they sold. But that's something that is quick liquidity. So Michael Saylor's using liquidity because he can sell Bitcoin pretty quickly. He can get cash, he can pay his preference shareholders, he can then go back and buy in the market again. Quick liquidity. China has concern that investors don't have the liquidity to meet their obligations on leverage trading. Hence, it is banning the trading. Morgan Stanley, North Haven Fund, it is a quarterly withdrawal. So you have to wait up to 3 months to get your money back out. So yes, there is a liquidity system, but it's not instant liquidity. You have to wait for those funds to become available. So when you look at them all, they're totally different stories, but they have liquidity as the main focus. Now, when we go back in history, there is a lesson that we can all learn from, and that was 2007 and the credit crunch. And that also came down to liquidity. And I was looking at it and I was sort of exposed to it through property. I was trying to buy property and the mortgage money was not available. When I started investigating why the banks were not able to put the funds out, I actually found that the higher property market, that's the properties that are in the millions, that had been frozen for quite some time. We had the high value properties, people were trying to sell, they couldn't sell, they were lowering the price to try and find a market. But the problem was there wasn't a liquidity issue. And so banks weren't able to lend to the extent that they had previously. And that became part of the trigger that created the credit crunch. Now, I'm not going to say it was just that, there were a whole lot of other factors that came into the credit crunch. But we actually saw that happening. I saw it as a property investor. I saw this liquidity freezing up. Now, it affected all the property markets below. When I say the property markets, imagine a ladder and there's price brackets, and you get up to the top, which is your multi-million pound portfolios or dollar portfolio. Because these high value properties couldn't sell, the people below who would normally be moving up into those couldn't move. That blocked the next layer on the ladder and the next layer until we had a property market that was totally frozen. So liquidity is a really important factor, and it is behind everything that happens in the financial markets. Now, I'm not saying that we are in this situation today. Yes, there are some signals that are happening around the globe. And yes, I am seeing some high value properties that are struggling. Yes, I've already talked about people having to withdraw funds from funds, what China's doing, etc. So there are little signals. But what we have to remember is that in 2007, the market conditions that existed then are totally different today. So I'm not saying that we're heading into something drastic. What I'm trying to do is explain to you the effect that poor liquidity can actually have. And it's one of the reasons that liquidity is important to build into your portfolio. And when you're building a portfolio, I see a lot of people who are, I am just property. I can leverage property. And I have clients who tell me that I don't want to get into anything else. I have property, I can leverage it, I'm fine. But then I see property investors who are selling up their portfolios and moving everything into cash. So it's the interpretation of the markets at the time. When you build liquidity into your investment portfolio, you want different types of investments. Investments that can convert easily, investments that are cash orientated, as well as higher leveraged investments such as property. The different layers that you have within your portfolio means you will have more resilience when we get into downturns. And that is really why why liquidity is so important. The more you can build it into your portfolio, the quicker you can react to market conditions. And when you have a liquidity, you can take advantage of the opportunities that come along. So when I'm talking about opportunities, I remember back in 2000, right, I had just arrived from New Zealand back to the UK, and the UK was coming out of a recession. we had a share market that was mega undervalued. Liquidity allowed me to buy shares at a low price that went up. I'm lucky, I understand investment cycles, so I could see that we were in a cycle that was about to break. Liquidity allowed me to pay cash for property that then went up and I could leverage it. Okay. Liquidity allowed me to buy the shares. Liquidity allowed me to set up businesses. So liquidity is an important part of risk management within your investment plan. Now, that might sound like a few big words. In other words, make sure you have liquidity built into your portfolio. So you have cash investments or assets that can be converted very quickly into cash. Liquidity is the hidden force behind every financial market. And when you can understand it, you can see what is happening within those markets.